This is the second half to the adjustments for the 2015 company question Melba Limited. So the first video looks at the adjustments 1 to 5, and we're picking up here at this sixth adjustment. A new warehouse was purchased during the year for 100,000 plus VAT of 13%. The amount paid to the vendor was entered into the billings account. No entry is made in the VAT account. So what's going on here? A new warehouse was purchased during the year. A new warehouse, obviously, buildings was purchased during the year for 100,000 plus VAT of 13%. So the buildings are 100,000, and there is an additional plus VAT. So if something's plus VAT, that means the VAT is not included in this 100,000. Obviously, 13% of 100,000 is 13,000. So the building itself is 100,000, and the VAT is 13,000. The amount paid to the vendor was entered into the billings account. So a vendor is a seller, and the amount that we paid to the seller was entered into the billings account. So what you have to understand here is that when you are paying for a building, let's say, and there's VAT involved, you pay the entire building plus VAT to the seller. The seller will then give the VAT to the government as VAT they have earned. But what you pay the vendor will be the full 100% of the fixed asset plus 13%, 21%, whatever of the VAT. So the amount paid to the vendor was entered into the buildings account. The amount paid to the vendor is 100 plus 13%, it's 113%, but the buildings account should never go beyond the 100%. It should always be the cost of the fixed asset itself, and it doesn't include the VAT. So the amount entered into the billings account should be 100,000. It should not include VAT, but it's telling us that the amount paid to the vendor, the amount that we actually paid, was entered into the billings account. What does that mean? It means that when this transaction took place, we entered 113,000 into the billings account, and we got billings of 713,000. We need to take out the 13% VAT. Just the VAT. We don't need to take out the 100,000. Obviously, that was buildings that we've added to, but we need to take out the VAT. So our buildings are 713,000, and we need to take out the VAT because the amount paid to the vendor was included in the buildings account, and it shouldn't have been the amount paid to the vendor. It should have only just been that 100,000 that we see. 100,000 that we see here. So the account itself, 713,000 minus 13,000, which was VAT, and we arrive at our buildings figure for our balance sheet of 700,000. The only other thing to change there, because we don't need to touch the bank or anything like that, the only thing we need to change here is the entry was made in no entry was made, sorry, into the VAT account. So the VAT account doesn't include anything here. If we look at the trial balance, we can see that our VAT has a credit balance at the moment of 5,000. Obviously, this is the credit balance that's given here, 5,000. I'm just showing this debit of credits because I think it's easier to look at it from the same perspective as the trial balance. This is on the credit side, so it's on the credit side here. But what we have to think through here is in terms of the VAT account, the credit side is when it's a liability, it means you owe money, and the debit side is when you've paid off VAT. So every time you owe more VAT, you add to the credit side. Every time you add a figure here, it means you owe more VAT. You'll have a liability figure here of 5,000 or 6,000 or 7,000. And that's the money that you then owe the government at the end of the year. But whenever you pay VAT, it goes on the debit side, and you no longer owe that VAT. So basically, we paid 13,000 VAT. We would have handed that over to the seller, and we had a 5,000 debt of VAT. Obviously, they're being offset here. The same way that if you owed your friend, 20 euro for a taxi, and then the next day, so you owe them 20 euro, then the next day you go get them, a bit of food or something like that, and then you've paid 10 euro their food. You really only owe them the other 10 euro now. You're hardly going to I'm totally lost in the example I'm giving. Um, you basically, if you owe somebody an amount of money and then you pay back a certain amount of it, you're not going to go through the transaction and say, okay, here's the 20 and then you give me the 10 back for the food. I'm going off on a complete tangent. I should probably cut this out, but I won't. The 8,000 therefore is the remaining amount that's left to pay. 13,000 has been paid, 5,000 is owed, therefore there's an 8,000 euro difference. That 8,000 just happens to be on the debit side, which means that it is an asset. So the VAT account will actually be an asset at the end of the year in the balance sheet. It's an asset of 8,000. The note number 7. So this note number 7, quite common in company accounts. Some people find it quite difficult to understand. So I'll try to go through it a little bit slowly. It's not actually that difficult. Um, it may take a couple of goes for you to just get your head wrapped around it. The figure for the bank in the trial balance has been taken from the firm's bank account, i.e. this guy here, 50,000. This is from the firm's, this is from their, basically, that's their accounts, 50,000. However, bank statement arrived at the end of the year showing an overdraft of 46,690. So what do we see? The bank has an overdraft of nearly 47 grand, and we actually have an overdraft in our accounts 50 grand. So there's a difference there, and we obviously need to find out, okay, why do our bank accounts show that we should have 50,000 debt, and yours say that we've around 47,000 euro debt? Comparison of the bank account and the bank statement has revealed the following discrepancies. These three things, and there's always three things listed here, these are the differences between our bank above and the bank statement that we just received. So we need to find out, okay, if there's one thing that's entered into one of the bank accounts and not into the bank statement, how do we go about fixing it? The first of the three is 2 months investment income had been paid directly into the bank. Just to let you know, the structure of this is always the exact same. The first two here are aimed at fixing this guy, 50,000. We do not care about the bank statement. Where am I? We don't care about this 46,650. We're not going to look at that until we get to the last one, because this is the bank statement. And the bank statement, just the bank will put through whatever information we give them, but this two first pieces of information here, we actually haven't adjusted these in our own accounts ourselves. The bank statement includes them. The bank has obviously recognized that money's been put in or taken out, but we actually didn't track this ourselves in our own account, so we need to change our 50,000. The third one is always phrased as this has not been presented for payment. If something hasn't been presented for payment, that means the bank actually don't know this took place. So for the third one, we're going to change the bank statement figure. May sound confusing, I'll go through it now. First one, 2 months investment income had been paid directly into the bank. Well, if you look here, we started with investment income earlier on. We had seen, it was in note number 2, I believe, with patents. We had looked at it here. The investment of 350,000 at 3% is 10,500 was our 12 months investment income figure. That 10,500 is obviously a gain. That's full investment income for the year. Again, I'm just taking that from my 3% investments at the first of the first, multiplied by 350,000, 10,500. I suppose the adjustment that we have to make here is that we're looking for 2 months investment income had been paid directly into the bank. So that 10,500 is our income for the year, and we'll have received some of this during the year, and then obviously we'll be able to find how much money we still have to receive for the end of the year, the money that's due at the 31st of the 12th. So the investment income that we are owed is 10,500, and we've actually gone and we've received 2 months investment income already. They were directly paid into the bank, so they've been paid to us already. 2 months is 1,750. So if I've received this 1,750, I need to take it away from the investment income gain figure, and then that way I can find out how much investment I still haven't received. So we can find that for our current assets at the end. This is from note 2. This was the investment income that was included in patents. The 4 months, it worked out at 3,500. We've dealt with that already. So that's money we had received. And we've also received this 1,750. 2 months investment income. We've received it. I'm going to take it away from the investment income figure for the year, and I find out that I have €5,250 that is due to me at the end of the year that I still haven't received. That is our investment figure for current assets. Now, we need to change all of these figures. I suppose you need to kind of make two entries for each figure. So we've looked at the investment income note. The other note we need to change is the bank note, because this information, these first two, have been completely omitted from our accounts. We haven't dealt with these at all, and we need to deal with them properly. So the 2 months investment income has been paid. I'm going to take that away from how much my investment investors owe me for income, and now I'm going to look at it from the bank's perspective. So the bank, we have an overdraft of 50,000. So our overdraft here is 50,000 on the credit side. That is how much we owe. We have received, where are we here, 2 months investment income. That's 1,750. We've worked that out. So if I receive 1,750, that's positive. It's going to increase my bank balance. So my bank balance was at 50,000, and now I'm going to add 1,750 from the minus 50,000. Therefore, our bank balance will currently be minus 48,250. We have reduced our overdraft. I'm not going to finish the bank because there's more to come. The second part of this is a payment from a liquidator was received directly into the bank. This represents a first and final payment of 25 cents in the euro in respect of a debt of 4,000. What does this mean? So a payment from a liquidator received from the bank. We have received money from a debtor, and this debtor is somebody that was previously written off, I suppose, as a bad debt. A payment from a liquidator or may or may not have been written off previously, but this person anyway is struggling, and they're paying us, and it's a first and final payment in respect of a debt of 4,000. They owe us 4,000, and they've made a payment to us of 25 cents in the euro. 25 cents is obviously 25%. It's going to be 25% of the 4,000. So if ever they say 25 cents for the euro, you get 25 cents out of the euro is the same thing as 25% of 4,000. So 25% of 4,000 is 1,000. It's a fourth. So they paid us 1,000, and the rest of this isn't going to be paid. How do I know that? So out of the 4,000 debt that they owe, they've made a first and final payment, and they're paying us for a quarter of the debt. So they paid us 1,000, and the other 3,000 is going to go as a bad debt. So showing this here, a payment from a liquidator. So we've received 25%, as we've seen here, the 25 cent in the euro of a debt that was owed to us. Therefore, the other 75% has now been written off. We won't receive it, and it has to be cancelled from our debtors balance. So our debtors balance here, to be careful, this is our debtors balance from the note 1, I believe. So our debtors balance here given in the question was 99,200, but in one of the earlier notes here, it was actually note number 3. We had looked at 400 from a discount. So this is our debtors balance that we're taking from here, and I'm carrying it on down here. So 98,800 is my debtors balance. If you wanted, you could go up to your workings from note number 3 and adjust your debtors there. I've just decided to bring that figure down here. Very important though to take into account that you previously already changed debtors. Otherwise you're going to obviously have the wrong figure going into your balance sheet. So this is how much our debtors owe us, and they paid us 1,000. Obviously they don't owe us that 1,000 anymore. Now they only owe us 97,800. However, that payment represented a first and final payment in respect of a debt of 4,000. Therefore, they are not paying the other 3,000. The other 3,000 is going to be a bad debt. So we have to cancel the bad debt because they're not going to pay us. What's the point in continuously having 3,000 in your account, waiting for the day they're going to pay you, when in reality this debtor has gone broke or they've gone bust and they're not going to pay us this 3,000. So we're taking this out. We're taking the full 4,000 out because they paid us the 1,000 and that they've told us that not a hope are they going to be able to pay us the last 3,000, so that has to cause a bad debt. Therefore, the remaining balance on our debtors, they owe us 94,800. So the bad debt written off here, we have our cancelling of the received of 1,000, and we have our bad debt written off here of 3,000. Apologies, that is 4,000 by mistake. So our they paid us 1,000. That's obviously gone into our bank. We'll look at that in a second. And we've written off the other 3,000. They're not going to pay us, but all 4,000 needs to come out of debtors. So the 3,000 here is a selling and distribution expense. That's going to go into our P&L. But this remaining, I suppose, bank adjustment figure that we need to make is going to be the money that we've received from this debtor. Again, we have received 25 cents in the euro. We've received a quarter of the debt that they owed. So we've received 1,000. Therefore, if I receive 1,000 euro, it's positive here. I'm going to add this into my bank account, which is previously at an overdraft. Therefore, my overdraft is now dropped to 47,250. It's current liability, balance sheet, that is your bank overdraft. So we've looked at the first two. Now the only thing left to look at for this note is our check issued to an advertising firm. So this here is always phrased in the same way. This had not been presented for payment at the end of the year. So if it hasn't been presented for payment, they're basically telling you, we didn't present this to the bank. The bank has no idea this took place. So we paid an advertising firm 560 euro, and the bank didn't know this didn't happen. They didn't know that it happened. So previously our bank debt for our bank overdraft, for our bank statement was 46,690. So again, this one here, we're ignoring the other bank note that we've done because this has not been presented for payment. Now we deal with this bank figure, so it's always the same. First two adjustments, you deal with the earlier bank figure on top, and the last one will always say this has not been presented for payment. It's always a check, and you'll always adjust this guy here, the 46,690. It's the bank statement balance. So my 46,690 is the balance for my bank statement. What happened? Well, we have paid an advertising firm 560. Therefore, we paid more money, which means we're going to basically have a higher debt. So my debt is now gone up to 47,250 on my bank statement. Notice a trend. My bank balance here was 47,250. That is my actual bank balance from my company accounts. That's the figure here that we've adjusted the 50,000 for. That's going to go into the bank, or going to go into the balance sheet. This doesn't go anywhere. So you don't enter this again as another form of a debt. This is just basically confirming that both of these match. Those two figures match, and unless you've managed to completely mess things up a small bit, generally if those two things match, then you've done this correctly. So the 47,250 is the bank statement, that's the balance, and our own accounts have a balance again of 47,250. So that's perfect. Both of those match. That doesn't go anywhere. Try to understand that straight away, just so that before you maybe forget it. It's a common enough mistake. People also enter this figure into the balance sheet, but it doesn't actually go anywhere. Okay, the last note. This is kind of tying up loose ends. The directors recommend that provisions be made for investment income due and debenture interest due. So investment income due, I already did this. Actually, this is kind of something that a lot of people get caught out on. They don't always ask you to do this, and people do the investment adjustments up here, and they never find out how much of the investments that we've yet to receive. So if you look back at our investments adjustments that we've made, we found out the 10,500 at the start. We took away what had been included in patents because we'd already received that. We took away this guy here as well because we already received it as well. So this is the investment income that was due at the end of the year, and we've already adjusted it here. Sometimes they don't even tell you to adjust it at the bottom. You still have to adjust it, and a lot of people forget about it because it's not instructed to them. So we've done that one already. The other one we have to do is debenture interest due. Same thing. Our debenture interest, we had worked this out as well for the suspense note. It's 400,000 by 8% is 32,000 is the full year. But what we'd worked out was that our debenture interest already paid was 16,000. So if you can remember up here, we saw that our debenture interest figure was included in the accounts was a mistake. We fixed it, and the debenture interest for the first 6 months that we actually should have paid was here, 16,000. Where is it? It's up just above this one. 16,000. So that's the first 6 months. That's the debenture interest we've already paid. So if I owe 32,000, that's how much I owe in total. And I have forgotten actually to circle that. I do not have a user-friendly laptop, so I'm using my mouse for this. The 32,000 here is my expense figure for my debenture interest. It's not admin, it's not selling in distribution, it goes at the bottom. The same way the mortgage interest will go at the bottom of the P&L, the debenture interest is dealt with in the same manner. So that's the 32,000. That's my expenditure for the year. I've paid 16,000. Therefore, my balance sheet will show 16,000 due at the 31st of the 12th. Okay, so that's that one done. Second one here, provision for bad debts to be adjusted to 4% of debtors. Now, debtors required us to. We were required to change this twice. We changed it above here, and then again in the banknote. We went off and we changed debtors again. This was our debtors balance, 47,250. Sorry, I'm reading this completely wrong. This was our debtors balance, 94,800. That's our debtors balance. So providing you get that right, it sets you up here nice and easy to pick up a good few marks. We have our 94,800 as our debtors balance, and our bad debt is going to be adjusted to 4% of debtors. So I'm going to get 4% of my new debtors figure, and it's 3,792. This is my provision for bad debt. What am I going to do with it? It's going to offset from debtors. If you can remember, in the current assets, you debtors less provision for bad debt, 3,792. So that's where that goes. But we also need to change, because if you look at your trial balance, and please always go back to look through your trial balance, we can see there is an existing bad debt provision of 4,000 on the credit side. So this 4,000 here was the old bad debts provision. So I need to adjust this to 4,000 minus 3,792. Gives me a decrease in provision for bad debt. If I've decreased my provision for bad debt, it means that I have basically, I expect to actually receive a little bit more money, so this is a gain. The difference between both of these, if it's a decrease from the old one to the new one, then it's a gain. A decrease in provision for bad debt is 280 euro gain, and obviously if your new provision was higher than 4,000, it would be a increase in provision for bad debt, and that would be a loss. Basically, try to think of it like this. We expected to not receive 4,000 from our debtors. We expected to have a bad debt for the year of 4,000, but now we're actually expecting it to be 3,792. So we expected to have greater losses than we think we will have now. So this is a positive. Finally, just to finish this up, the last two ask us to get depreciation at 2% of buildings. We've dealt with buildings when we took out the VAT earlier. The buildings figure for the year is 700,000. By 2% gives me 14,000. There is no accumulated depreciation on buildings. We're not told any cost figure, net book value figure, and we're not told anything here about accumulated depreciation. So this 14,000 is going to go in, nor are we told anything about our evaluation. So this is going to go in as accumulated depreciation. I should add into that. Again, I can't find the mouse properly here. Accumulated depreciation. Also not great at drawing with my cursor. The other entry that's made here for that 14,000 is the usual expense, and buildings is an admin expense. Finally, last thing we're asked to do is get commission. The managing director should be paid a bonus commission of 3% on all sales in excess of 900,000. So every bit of our sales above 900,000, all our sales above 900,000 in excess of 900,000, the managing director will receive a bonus commission of 3%. There's also a further 5% in excess of all sales above 1.2 million. You need to be careful of the wording here. So this managing director, this person at the top of the company, is going to receive a bonus commission of 3% in all sales in excess of 900,000, and a further 5%, which means an additional 5% in excess of all sales above 1,200,000. So my sales figure, just so to have this sales is here, and we haven't adjusted it. My sales figure is 1,495,000. So every bit of that sales figure above 900,000 would get a 3% increase. However, they're telling in terms of a commission, but they're telling us that from 900,000 to 1.2 million, they're getting a 3%. He's getting a 3% commission. He or she, sorry. And the above 1.2 million, above 1,200,000, they're getting a further 5%. That means everything over 1.2 million will actually have 8% commission. So the easiest way of doing this, I think, is getting the 300,000, which is the difference between the 900,000 here and the 1.2 million, and getting that at 3%, which gives you 9,000. And the fact that you're getting 3% commission and then a further 5% commission for everything over 1.2 million, it means that from 1.2 million here to 1.495, that 295,000 will be at 8% commission, 3 plus 5%, and that amounts to 23,600, which means the total commission that this managing director will earn is 32,600. This goes into selling and distribution because it's to do with selling. It's sales commission. It's an expense because this is money that we have to pay out. And it's also a liability because if you notice the wording, it said the managing director should be paid. This is the same as the wording up here we've seen for the insurance company. The insurance company has agreed to pay. They haven't paid us. Therefore, that was a current asset. This is the same thing. The managing director should be paid, but we haven't paid it yet. So this doesn't affect bank. What this affects is our current liabilities, as we're going to owe this money. We haven't paid it yet. So this figure will go in twice, selling and distribution expense because it's to do with sales, and the total figure as well will also be owed because it should be paid. It hasn't been paid yet. So it's also going to the current liabilities.